today's presentation, we're going to be reviewing protective puts, covered calls, and then we're going to go into the traditional collar, and then we're going to do something that I really think is interesting, which is the put spread collar. Oops. So for the protective put, as we learned last week from the presentation, it's a way to hedge against any kind of significant downside move that could impact the price of your stock. So the protective put itself, not the protective put, a put itself is a bearish strategy, right? Typically you'll buy a put because you think the stock is going down. Now, for many, this is a great way to protect whatever your portfolio is or your stock that you might own from markets that have like extreme volatile moments, or you're just concerned about it going down, even though you may feel pretty bullish that you think the stock's going up, or it's just a stock that you love and you want to protect. So we're going to review what that protective put looks like. And, typically when someone wants to buy a protective put, they have to figure out how much protection they want. And that means what strike and how much time you're going to give available to that protection. So if you're looking at, let's just start with strike price, you want 100% protection, you're probably going to be looking at a strike that's at the money. Now, that at the money strike is probably going to cost you more than, let's say, an out of the money strike. So if you're buying full protection, you're going to pay more for it. But if you're willing to limit that protection by buying an option that's further, out with a lower strike, then you could be able to buy an option that costs less than that at the money option. So those are the decisions that you're going to have to make. The other bonus of buying that put is that you are in control, right? When you buy any option, you have a right to exercise that option or to not exercise that option. So you're in control of what that outlook is, because for many, I know you don't like the idea of your stock being called away. And for those that don't, you can always get out of the put, or you can roll the put, or you can choose not to exercise that put. Now, that's all dependent on how far that put is in the money. You certainly don't want to not exercise a put that has value, because you'll lose all that value. But again, this is what's in control by buying that protective put. Lastly is, you're going to have to pay something for that put. And like all insurance policies, if you don't use it, that is money. Whether you want to say it's wasted or not, that money is just gone. So when you're buying a protective put, that is something to always keep in mind. And when we roll into this collar strategy, I'm going to go over how to mitigate the price that you're paying for that particular put.